Bond market volatility is rearing its head again as strong data sends the 10-year towards a 16-year high. Investors are concerned about pressure on the mortgage market, Fed rate hikes, and the crisis in the Middle East, all contributing to these swings. For more on this, we've got Yahoo Finance reporter and family, Jared Blikre. Hey, Jared.
I think it's great to be family here among all of us here. Let me talk about the yield curve. In fact, I have three on here. This purple line is the current yield curve, U.S. Treasury, as of today. And it starts all the way down by 1 month. It goes to 1 year, 5 years, 10 years, 15, all the way up to 30 years. And you can see here that it is much higher than these other two lines. Now, the middle one is where the Treasury market was about a week and a half ago. The orange one was just over a month ago. Suffice to say that we are rocketing higher on the long end of the curve. And this is just a 20-year that I'm pointing out right here, but the 10-year and the 30-year as well. All of this puts pressure on other markets. Why? Because treasuries are supposed to be safe haven investments. They're supposed to be risk-free. So when they start moving a lot, and when you have prices on bonds going lower, sending the yields higher, banks and other entities are taking capital losses on there, and they have to reserve for that. So there's not as much money left over for all the other markets. And what we're seeing right now, we're seeing some of the biggest realized treasury volatility that we've seen since that March internet banking panic. And let me just graph this in some other indices. We talk about the VIX a lot, but let me show you what the MOVE index, and this is kind of like the VIX of the bond market. I'm going to put a 3-month there. Well, why don't we just work with this? This is a year-to-date chart. You can see over here at the very right edge, we have a higher high than what we were seeing a couple months ago. However, we are not approaching the volatility, the implied volatility levels that we were seeing back in March. Now, what's the difference here? What we're looking at is implied volatility, and that just means what's expected by options market and people that are trading in the options market. So there's not as much fear as there was in March. However, the movements are just as big. Putting this all together, it does seem like we're going to be able to roll out of this somehow, but there's a lot of things that could go wrong, and it depends on how high these yields eventually go. You take a look at the very short end of the spectrum. This is the 13-year T-bill yield. That's at 5.34%. Haven't seen any of these levels basically since about 2007, almost getting back into 2006 territory. But as this short-term yield shoots higher, all these banks, all these companies, all these corporations that we talk about, they have to change their calculations. And when they do that, that usually means that there's not as much money left over for the risk markets. All of this to say, probably more pressure on the bond markets here. But the good news is the implied volatility, the expectation of fear is a little bit lower, so that if, in fact, we don't have a market clearing event, if we don't have the bond vigilantes really rear their ugly heads, this should be kind of a one-off and a shorter experience for bond and equities traders, guys.
All right, Jared, thanks so much for breaking that down for us.